Here we
You're
go.
live.
We're live. We're live again, so welcome back, part 2.
Okay, so we're going to talk about CGT.
Yes.
Okay. So as I said before, if somebody's bought a plot of land and in their company they build one property and they don't do anything else, that's one thing. But say then the next year, early next year, they do a second and maybe a third house. How is it? So as far as I understand, I'm not an accountant.
Sure.
If you do one, then you're not trading properties. It's seen as capital gains tax,
Yep.
and you're liable for that.
Okay.
But if you do multiples, and please tell me if I'm wrong, if you do multiples, then you can say, well, I'm trading properties, and now it can be under income or corporation tax if you're doing it through a company.
Yep. Well, let's talk about in the round.
Please.
And I have to get this in.
Yes.
Capital gains tax is a tax that you pay when you dispose of an asset that you've yielded a return from. So if you have a buy-to-let property that you've rented out and you've got some profits from that, that will fit nicely under capital gains tax or shortened CGT. Now, the issue comes about whereby you've got innocently someone who's purchased a property in an auction, a bit like me, Trevor.
Yeah.
I've purchased a property, shouldn't say this live, but I've purchased a property on my wife's credit card without her knowing. So yeah, that went down a storm. But imagine leaving that aside.
A nice present. Did you wrap it up and say, darling, I bought you something with your
I
own
gave her the keys in an envelope, and she looked at me horrified.
Oh, fantastic.
And to this day, she still talks about it. And that was 6 years ago. So anyway, I digress. So we're talking about a couple innocently buys a property, sees it on market. That's a good, real deal here. Let's buy that, do it up, and then sell it. And naturally, what HMRC will see is say that as a trade. It's not an investment. You haven't actually got a return from that asset. Therefore, it can't be deemed to be an asset from their side of things, and therefore it would be an income tax. So you can pay a lot more tax than you expect. Yeah. And there's a lot of people who fall foul of that. You've got income tax instead of CGT, capital gains tax. And income tax, depending on how much you earn, but if imagine you earn £200,000, you could pay 45% income tax plus the national insurance charge as well. Yeah. So you're talking about 47% tax. Compared to if you did buy a property and you rented that property out and then you sold it, you would get certain reliefs. You have one called capital gains tax allowances, which is 11,700. So if you had an asset, you made a gain of 11,700 in just your own name, then it would be tax free. Yeah. We'll talk about that actually, because this is an interesting one whereby people will say, I've had a property in my own name, I'm about to sell it. Yes. What's the best tax advice you can give? And I say, well, you're married, aren't you? And they say, yes. So, well, why don't you do a deed of trust the day before you sell the property? Because then you've both got 11,700 capital gains tax allowances to use. So you doubled the amount of money you can earn before you get CGT bill.
Love that.
And especially the case, now we know that capital gains tax for residential properties is 28%, and for basic rate taxpayers is 18%. We're always looking at couples to say, well, let's change the share ownership before you sell the property, because let's not forget, there's no CGT between couples. Yeah. So that's okay. You can do a deed of trust, and we can do it at the right percentage. So we've created a spreadsheet, which we've, funny enough, have got on YouTube. You can download that. And it will tell you the exact percentage. Now, it does give out a really strange number. It might say, this person should have 36.5% and this should... But it's a strange calculation, but it works. Perfect. And it's like electricity. When you switch the light on, how does it work? Who cares? It gives you the result.
Absolutely, I agree.
So that side of things is, minimizing CGT. Let's go further about capital gains tax, because there's things like EIS investments. EIS, before you kind of straight into this, is enterprise investment schemes. There are SEIS, which is small enterprise investment schemes as well. And you've got VCTs, which is venture capital trusts. And you could take your gain, that's taxable for CGT purposes, and invest that into one of those schemes. Right. And it basically defers it. Now, if you do it right, you could defer it indefinitely,
Oh.
or you can release the cash from those investments over a period of time to utilize your CGT and allowances. So I always say, anyone listening to this, is people say, well, can you minimize CGT? And everyone says, it's a bit dodgy, isn't it, if I don't pay capital gains tax? And I'm saying, well, if you ask the Lord and Manors of this country, are they paying tax?
Yeah.
They've got a clear answer. Don't be stupid. That's what we pay good accountants for.
Yeah.
So ultimately, CGT as well as IHT, no tax if you want to do it that way. Now, capital gains tax is also in limited companies, so we can't forget that. So if you're doing flips and trade within a limited company, capital gains tax is still part of corporation tax.
Yes.
So right now, if you made £100,000 gain in a limited company, it does not, and I repeat, does not get the capital gains tax annual allowances at all.
No.
But what it will have is a lower tax threshold. So remember before I said about a basic rate taxpayer paying 18% tax. Well, in the future, a company will only pay 17% corporation tax.
Yeah.
So it could be more beneficial depending on how much profits you're making.
Yeah.
So there is a real difference between capital gains tax in your own name versus capital gains tax in a limited company. But they are still the same kind of tax.
Yeah. Look, so Simon, it's been absolutely superb listening to you, because when you have an expert around the table and giving you these golden nuggets. Look, all the things you've been telling us. I love the freezer shares. I love the vouchers.
Yeah.
£300 a year.
Shh. I think she's listening in.
She may well be. But all of these things. And the capital gains tax that you're saying that we can defer and we don't ever have to pay it. Personally, I think it's absolutely brilliant. But you're just showing the value of working with the right people.
Thank you ever so much.
And that is right. So listen, I loved having Simon here. He's been a great value to me. I hope it's been a fantastic value to you, and I look forward to seeing you next time. So look, Simon, thank you so much.
Thank you.
Any final words?
I think the key thing for me is education. I can't overstress it. We are seeing, and I can't obviously mention names, but I'm seeing across Facebook, I'm seeing across LinkedIn, other social media channels, where people are not getting the results that they wanted from their property investment portfolio. And that's where I would say education or support. Now, we don't do mentorships, but I know that Trevor has got the table of 12, which I don't know if he wants me to talk about that. But I do think that there's a lot of support they can get from a mentor or some sort of support mechanism to help people understand which properties they should be getting involved in, because there's some pretty bad deals out there, right?
They're awful. And look, I think you really sort of hit it there. A small amount of information can be very, very dangerous. I'm asked an awful lot of questions, and if it's around tax, I might have an understanding, but I'm not a tax accountant. And I always point them. I said, you must speak to your tax accountant. But there's too many people in the property circuit who are not tax accountants will happily give tax advice. And unfortunately, that is a moving river, because every now and then you get changing legislation and here and there, and what you can allow and what you can't, because that's changed in the last few years.
Yeah, certainly.
And a little bit. So look, my advice, not being a tax accountant, is go to a great tax accountant. I'm going to put Simon's email on the end of this, and so please feel free to contact him. I think he's one of the best accountants in the country. I really do. I've known him, seen him train, and the way he talks, I couldn't praise him highly enough. So look, Simon, again, thank you so much for coming along, and I look forward to...
Just before we go, it's not actually me. That's the good accountants around here. It's my team that do the work. I'm just the glory boy who gets to sit in front of good people like yourself.
Hey,
have all these lights shining on me, making me feel really good about myself. But the truth is, we've got some very good accountants in our firm, and I'm delighted and honoured to be working with them. And they're catching me up in terms of saying, what you should be talking about in this presentation, even today. So we've got a good team. We've got a good team.
And the name of the firm?
Yeah, of course, yeah.
Please do.
It's Optimise Accountants. You can go to our website, which is www.optimizeaccountants.co.uk. Also visit our YouTube channel, indeed Facebook page as well. We've got some events that are on there, free events, free webinars and so on. So make sure you register.
And I'll share the links as well. That'd be
Thank
great.
you. Yeah.
Listen, I wish you all the best, and I'll see you again soon. Thank you.
Thank you, folks.
Bye-bye.
Brilliant.